In Australia, we pay a lot of tax, but have you actually physically thought about, if I was to go out right now and put $50 fuel in my car, how much tax I would be paying? Well, let's just say I earn $100,000. First things first is 37% of that would be going as income tax. Then we're whacking on 2% Medicare surcharge. Then we are paying 10% GST on the fuel price, plus there is excises hidden within that fuel price. Then we all pay council rates and water rates, and we pay utilities, which are all government owned, and we need to pay them regardless anyway. And before I even got my money, my employer probably paid the government payroll tax. Everyone hates paying tax, and the simplest way to pay less tax is to not earn an income, but we can't live off hopes and dreams. So there are these smart boffins called accountants, which go out their way every year to think of different strategies in order to save you tax. I'm not a lawyer and I am not an accountant, but what I wanted to do is share with you some things that I have heard around the traps that middle to upper income earners use to optimize their tax affairs. Now, I didn't want to make this video a generic maximize your work deductions. I wanted to dig a little bit deeper. This is an important disclaimer, and as I mentioned before, I'm not an accountant, I'm not a tax lawyer, I'm not a financial advisor, and this is not any form of any financial advice whatsoever. This is simply just general discussion points that you will need to raise with your own advisor so that they can give you guidance based on your personal financial circumstances. Now, it is important that you go to the disclaimer that I have linked below in the description, because once you continue past this point on the video, you agree to be bound by the terms and conditions in the disclaimer. Some might say that tax is a lot like Fight Club in the sense that the ATO considers your intent massively when determining your tax situation. So it is essential to never go into a scheme with a view to reduce tax, and you should always seek professional advice. Firstly, let's talk about capital gains tax. Capital gains tax is a tax that you pay when you realize a gain on investment. This is not for enterprising and conducting business. This is purely buying assets to invest in and speculate to sell at a higher price. The first tax haven clickbait you must consider is your primary place of residence. Provided a house qualifies as a primary place of residence, if you sell it for more in the future, you don't pay any tax on that gain. Now, there is a common misconception with qualifying for a primary place of residence. The ATO has a fairly comprehensive list of what qualifies as you as a primary place of residence, but the misconception is that you need to live in it for a minimum of 6 months. There is actually no time limit as determined by the ATO. It all comes back to intent. There is also a right to reset this timer, meaning that if you come back into your house after 6 years and you live in it again for a period and then are forced to leave again for work, you will be able to claim that as a primary place of residence for up to 6 years later. So in terms of dollars and cents, how much do you actually save with this exemption? Well, hypothetically, say in that month you bought a property for $300,000 and you spent some money renovating it. It owes you about $330,000. Now in 2 years later, you had some growth and you sell the property for say $400,000. In that scenario, under the primary place of residence exemption, you would pay no tax. But say you held it as an investment property and it didn't qualify as a primary place of residence, basically if it owes you $330,000 as a base and you sell it for say $400,000, there would be about $11,000 tax payable, provided you also qualify for the 50% CGT discount. This brings me on to the 12-month CGT discount, and this is another thing that can save you money with capital gains tax. If you hold an asset over 12 months, you are then able to get a 50% reduction on the capital gain. Effectively, what that means is that you only pay half the amount of tax that was due. There is a common misconception that we should only keep our receipts for 7 years, and this might relate to income tax reasons. But actually with capital gains tax, you need to keep your receipts for the asset for the entire time that you hold the asset. And the reason for that is when you calculate a capital gain, you also calculate improvements to that asset. If you spent money on improvements 10 years ago and you're selling an asset, you can actually claim those improvements 10 years ago on the cost base so that it will reduce your capital gains tax bill in the future. Another interesting quirk when looking up capital gains tax on the ATO website is that cars and daily drivers are actually capital gains tax exempt. Now, I don't profuse to know all the rules and the technicalities about what cars qualify as your capital gains tax exempt vehicle, but let's just think about if you drove a luxury car. Now, since 2015, the luxury car industry has seen the index go up over 200%. Does this mean that if I owned a luxury car and it was my daily driver and I sold it for a gain, would I have to pay tax on that? While we move on from capital gains, let's talk about capital losses. And there's an interesting conundrum when you consider international property. I'm just going to run through a hypothetical example because this is probably the easiest way to explain the situation. So in 2001, let's just say hypothetically I purchased a unit in London for £100,000. And in 2020, almost 20 years later, I decided to sell that asset for £80,000. It was a horrible investment and I lost £20,000. Now currently the exchange rate is around about 1.8 Australian dollars to one British pound, meaning that £20,000 loss is actually the equivalent of 36,000 Australian dollars. Would I claim that capital gains tax loss of $36,000? Well, the answer is maybe not, because what you need to take into account is the actual exchange rate as well when you purchase the asset. So in 2001, when I purchased that £100,000 unit, the exchange rate was about 2.9 Australian dollars to £1, meaning that in Australia, that relative unit's value was $290,000. When we fast forward to now, that £80,000 is only the equivalent of about 144,000 Australian dollars, meaning that I've actually lost 146,000 Australian dollars, and therefore instead of claiming the $36,000 as a capital loss, I could potentially claim up to 146,000 Australian dollars. This is why it's very important to get the right tax advice, because which number do you use on your tax return to be able to offset it against other capital gains? Another tax strategy that people often use is bringing forward expenses or deferring income or gains. So in property investment, one common thing you could look at is if you decide to prepay interest in advance. This might mean that expense comes all into this tax year. With commercial property, on the other hand, if you're renegotiating with a tenant and you're deciding to give an incentive to maintain that tenant, determining what type of incentive you give, say for example a rent-free period, might book the revenue in a later tax year. But what about stocks? Is there some way I can bring forward some losses in stocks? Well, there's actually a really good website called delisted.com.au, and hopefully I'm not the only one that's been guilty of buying a penny dreadful that either gets withdrawn from the ASX or suspended from trade. In that example, what might happen is those shares might go private. They may come back on the boards, that's a possibility, but in my experience, it often is a long process to go through administration, and ultimately those shares are worthless. The ATO doesn't care if you think those shares are worthless and they're never coming back from the grave. What they'll require you to get is a letter from the administrator or liquidator to state that those shares are worthless. But this could take a long period of time. The other option is a little bit different, is when you dispose of the asset. So this might be an arm's length transaction. When you sell those shares onto a third party, that actually determines an exit price for that share, which means you're able to calculate your entry and exit, and therefore you're able to book the loss into this tax year. Well, this is exactly what delisted.com.au allows you to do. They provide a service where you can sell those shares to them, and then that means you can enter the exit price. But ultimately, a lot of things can happen with those shares. So there could be a class lawsuit that delisted.com.au gains from that. They could get back on the board. So it's not always the best opportunity to sell those shares, but it just gives you an option if you never think they're coming back from the grave. I'm not affiliated with delisted.com.au in any way, but it's just a service that I thought was very interesting if you have had those penny dreadfuls like me. While we talk about penny dreadfuls, let's talk about being a stock investor versus a stock trader. Now, simplistically, a stock investor is someone who still qualifies for the 12-month capital gains tax discount. So if you hold the stock over 12 months, you'll be able to get a 50% reduction. A stock trader is not likely to get that exemption. Now, different entities can be stock traders and different entities can be stock investors. But what is actually the advantage of being a stock trader if you can't get that discount? Let me step you through an example, because being a stock trader allows you to value your shares based on accounting principles. Let's just say, hypothetically, you have a portfolio of 5 shares. 3 of those shares you haven't sold and they're currently worth more than what you paid for. One of those shares you've sold for a profit, and this is the tax burden that you may be paying. Finally, there is one share in your portfolio that is worth less than what you paid for it, but you haven't yet sold it. There are 2 different accounting principles that are important when valuing trading stock, which is shares in this example. The first way you can value shares is the purchase price that you paid for it. The second way is the current market price. So, in this example, the 3 shares that you currently own are effectively worth more than what you paid for them. So you could potentially use the purchase price that you paid for them. On the one share that's worth less than what you paid for it, you could use the current value of that. This means that you are able to deduct the reduction in that share's value against the share you've actually sold, ultimately deferring or reducing the amount of tax you're going to pay. Now, this is not necessarily a tax reduction strategy, as it is a tax deferral strategy. Moving out of the stock market into something different, a common thing that people talk about is debt recycling. Now, debt recycling at a very simplistic level is reducing your non-deductible debt, so debt on your primary place of residence, for example, and increasing your deductible debt, so debt that you hold over investment properties or a margin loan or a raft of other different business loans. So how does this all work? Well, one simple way is that a bank or broker could open a cash out facility against one of your investment properties. And then when you are to pay interest on those investment properties, instead of it coming out of your income, what you might want to do is capitalize that cash out facility. So effectively, the interest that you're paying on it is increasing that loan balance. With the money that you've saved out of your income that you're not putting towards your investment property, you can then use this to pay down your non-deductible debt. So the other kicker with this strategy is rental income. So if instead of using the rental income to offset the interest that's payable on your investment property, you might want to channel that rental income into your primary place of residence. Ultimately, this means that the interest that you're capitalizing goes up at an increased rate. But now, instead of your income paying down your investment property and your rent paying down your investment property, both of those forms of income are being channeled into non-deductible debt. When doing research into this strategy, I've noted that it could potentially be done with shares through dividends and margin loans, as well as potentially business loans. So it doesn't necessarily have to be property related. So the big scary thing with this strategy is that if you don't get the right advice up front, you're often chipping away at your non-deductible debt over multiple years, meaning that if there's a problem with how you set it up, it's going to take a lot of time to unwind, and often it's going to result in a lot of heartache and cost to you. While we are on the topic of property, another thing that property investors pay a lot of is land tax. And land tax is a state-based tax based on the value of the property that you hold within that state. So how can you reduce your land tax burden? Ultimately, it really depends on who the beneficial owners of your properties are. I'm going to run through a quick example. Let's just say I have 2 investment properties and a spouse. I currently hold both of those investment properties in my name, and they're $500,000 each. I will then go to the Office of State Revenue with $1 million of property, and in Western Australia, I'll pay about $1,750 in tax. The other option is, let's just say I have a spouse and we both have one of those investment properties each of $500,000. Both of us would then go to the Office of State Revenue and we would get assessed on our land tax rates, and each of those rates in Western Australia would be about $300 per property, meaning that the total tax payable would be $600. Effectively, I would save about $1,100 in that land tax. This does not really sound like much, but remember, property investment is often a long-term investment. So if you hold those assets for 20 years, effectively you're paying this tax 20 times over. The second thing to remember is that property investment primarily should be about capital appreciation. So as your property values increase, you're going to be paying more tax anyway. And the third thing is that the land tax rates are progressive, meaning that as the value of your property increase over time, the proportion of your tax is higher. So it tends to accentuate, especially if you have multiple properties worth a lot, the land tax bill which you would be paying. It's worth noting that every single state has a different set of rules around land tax. For example, in some states, if you hold a property in a trust, they look through that ultimately to the beneficial owner and then aggregate all those properties, whereas some states don't do that. Remembering as well that land tax is also based on a per state basis. So if you have an investment property in Western Australia and one in Queensland, the value of the property in Queensland won't necessarily impact the value of the property in Western Australia. This is where good advice is very important because firstly, if you need to change the beneficial owner of a property midway through owning that asset, you might be up for stamp duties again. Secondly, you might have decided to put 2 or 3 properties in one person's name based on income tax purposes to maximize the deductions against their income. So, as always, speak to your accountant, your financial advisor before you purchase a property because often if it's done wrong at the start, it's very hard to unwind. While we are on the topic of property, what I wanted to talk a bit about is depreciation. Now, the laws around residential depreciation has changed recently, which is something I'm not going to talk about. This particular section is going to be more about commercial property. In particular, this applies to unit trusts or managed investment schemes that also own the underlying asset of commercial property. In terms of dollars and cents, what does this actually all mean? Well, let's just say you own or a unit trust that you have a unit in owns a commercial property with a building value of $1 million. And a quantity surveyor has applied a depreciation rate on that building of 2.5%, meaning that you're able to apply a $2,500 discount or a depreciation against the income that you receive on that commercial property. The kicker often with this is that you're often using gearing, which means you might only have $500,000 of equity and $500,000 of debt, but you're able still to claim 100% of the depreciation in the structure. But there is no such thing as a free lunch. And what do I mean by that? Well, depreciation effectively reduces the cost base of your asset, meaning that when you sell it, the cost base, even if the capital value doesn't increase, has dropped. So the amount of capital gains tax that you pay on it increases. However, this is where that 12-month capital gains tax reduction kicks in, remembering that you are able to claim $2,500 against the full income that you received on that property. However, when you are paying the capital gains tax, you are now only paying the capital gains tax on half of what that property has been depreciated at. Effectively, for every dollar that you depreciate on that asset, you're only paying 50 cents of it back in tax. So all these schemes, concepts and discussion points are very simplistic and boiled down so that almost anyone can understand them. Technically, there is a lot going on there, so it is very important that you speak to your tax accountant, your financial advisor, and they will be able to talk with you about if any of these suit your particular situation. But once you've had that meeting with your professional advisor and you've gone through your personal situation and they've optimized your tax strategy, what I would encourage you to do is dust out the very best avocado that you own, smash it up on some toast, and enjoy the free money that you are getting from, well, it is the first rule of Fight Club. Thank you and enjoy.